Welcome to Min Chao, where law, finance, and real estate complexities are made clear, actionable, and empowering. The information provided on this channel is for entertainment and educational purposes only and does not constitute legal, financial, or real estate advice. For advice tailored to your specific situation, please consult with a qualified professional. If you'd like to consult with us, please book an appointment through our website. Investing involves risk, and you could lose some or all of your investment. Past performance is not indicative of future results, so whether you're looking to protect your assets, grow your wealth, or make intelligent real estate moves, you've come to the right place. Chapter 1. Stop making these common stock options mistakes. A frequent error people make is selling a put option when they expect the stock price to decline. However, it's important to remember that selling a put indicates a bullish outlook. You expect the stock to remain strong and you won't have to buy it. Even if the price falls sharply, you might still purchase the shares, just 100 at a time. Welcome to the world of stock options, where mere mortals like you and me can use tools once reserved for Wall Street wizards in pinstripe suits. In the realm of options, buying and selling can alter the story entirely. Purchasing a put option is seen as a bearish move, whereas selling a put option is considered bullish. So, let's kick things off with the basics. What are options? Why do they exist? And why do they just become your favorite wealth-growing sidekick? Calls versus puts. Venture into the exciting world of options trading, where stock options offer unique investment opportunities. Consider a stock option as a special pass. It allows you to purchase or sell a stock at a predetermined price, but you are not required to go through with it. It's similar to securing a seat at an exhilarating concert. You hold a ticket. Still, if you opt to stay in, that's entirely up to you. Key terms: strike price, the agreed upon price at which the stock can be purchased or sold. Premium, the upfront cost you pay to acquire the option. Expiration, the date when the option contract ends is akin to the due date for returning a library book. Payoff, the ultimate financial result when the option expires. Call option. A call option gives you the ability, though not the obligation, to buy a stock at a set price within a defined period. Imagine a call option as your VIP pass to a much anticipated concert. It lets you buy a stock at a designated price before a specific date. If your favorite band, the stock, decides not to perform and remains below the strike price of $50, you're left with a glitzy ticket, but no show, just a symbol of missed potential. But if the band lights up the stage and the stock price soars above $50, every dollar earned beyond that threshold is a sweet victory, pure profit after you account for the cost of admission. Visualizing the call option payoff chart. Now, let's take a closer look at the call option payoff chart, revealing the dynamics of profit and loss. X-axis, stock price at expiration, $0 to $100. Y-axis, profit or loss in dollars. The red dashed line on the chart beckons at the strike price of $50. If the stock price dawdles below this line at expiration, the option becomes as valuable as confetti. It's worthless. The green line illustrates the premium you invested, set at $5. The blue line represents your payoff. Below $50, you tread water, left with a flat line at -$5. Yet, When the stock price surges beyond $50, the line ascends, a visual testament to your burgeoning profits. Understanding the break-even point. You reach a magical moment at $55 when you break even. This pivotal point is achieved by summing the strike price of $50 and the premium of $5. Together, they form the threshold for profitability. It's here that your investment begins to flourish and yield rewards. Put option. Now let's shift our focus to the world of put options. A put option gives you the right, but not the requirement, to sell a stock at a designated price by a specified date. When you acquire a put option with a strike price of $100, you pay for the right to sell a particular stock at that price. No matter how low, the market value plummets before expiration. It's akin to having an insurance policy for your investments. You don't own the stock, but hold the power to sell it. You cough up a premium, your ticket, into the world of downside protection, allowing you the privilege to offload the stock for $100, even if its market price nosedives to $60. Analyzing the put option payoff chart. Let's further dissect the payoff graph for the put option. X-axis, stock price at expiration. Y-axis, payoff amount. The blue line illustrates the possible profit from your put option. It stays level and flat when the stock price exceeds the strike price, providing no benefits. However, as the stock price drops, the blue line climbs, indicating the growing worth of your option. The red dashed line denotes the strike price of $100, the critical point at which you can sell the stock. If the stock price goes below this mark, the option increases in value. However, if it remains above, it fades into insignificance and expires without worth. This vivid journey through the landscape of calls and puts empowers you with a deeper understanding of options trading. This exhilarating venture could reshape your investment strategy. Selling a call option. When you sell a call option, you grant someone the right to purchase your stock at an agreed-upon price, referred to as the strike price, in exchange for a premium. You confidently state, "I will allow you to buy my stock at a predetermined price if its value increases, but you must compensate me upfront for that guarantee." This approach offers you an immediate reward. You receive payment now, the premium. You may need to part with your stock later. What is the purpose of this? This method allows you to earn income from your stocks, especially when you expect price appreciation to remain flat or move downward. Selling a call option payoff. The payoff chart for selling a call option illustrates your path to potential profits and losses. It guides you through the dynamic landscape of stock price changes and shows where prosperity awaits. Imagine you sell a call option with a strike price of $105, collecting a $5 premium. If the option is exercised, you agree to sell your stock at that price, earning $5 per share right away. Key numbers: strike price $105, premium $5, break-even price $110. The red dashed line on the chart marks your break-even. Here's the point: $110, the threshold where you neither gain nor lose. Here's how the journey unfolds. If the stock price remains below $105, you confidently keep the $5 premium, facing no losses. If the stock rises above $110, your courage will face challenges, as you must sell at $105, despite its higher market value. If the stock you're buying is between $105 and $110, your profit may decrease. For example, at $108, you keep $2, the $5 premium minus a $3 loss. The green dashed line represents your maximum profit of $5, the premium you received. If the stock holds below $105, you seize the full $5 for your efforts. This is your best case scenario, a testament to your strategy. Regardless of market fluctuations, your earnings stay intact. Your awareness of potential losses grows as you look to the right side of the red dashed line. Exceeding the $105 strike price means conceding to the market, leading to increased losses as the price won't. This strategy shines brightest when you believe the stock won't soar. It's often used for stocks you own, though be aware of the larger profits you might miss in a strong bull market. Selling a put option. When you sell a put option, you take a brave step by agreeing to buy a stock at a specific price, the strike price. If the market price tumbles below that level, here's the return. You receive an upfront payment called the premium. Here's how this brave endeavor plays out. You can confidently keep the entire premium if the stock price surpasses the strike price, for instance, $100. If it drops below $100, you may need to buy the stock at that price, facing potential losses. Selling a put option payoff. The payoff chart for selling a put option empowers you to visualize how your profit or loss evolves based on stock price changes at expiration. Imagine selling a put option with a $100 strike price and receiving a $10 premium. You agree to buy the stock at $100 if its price falls below that threshold. If the stock stays above $100, you immediately embrace $10 per share as your maximum profit. Key numbers: strike price, $100, premium, $10 break, even price, $90. The red dashed line on the chart signifies the strike price of $100, marking a critical threshold for your journey. If the stock price ascends past this line, you are safeguarded and able to retain your maximum profit. However, as the price dips below $100, you face the test of responsibility, with potential losses growing as the stock declines. The black dashed line represents your break-even point. With a $10 premium, this point is $90. If the stock drops to $90, you stand firm with no profit or loss. If it falls further, you encounter losses. Still, if it stays above $90, you relish your profits, reaching maximum profit if it holds above $100. The yellow line signifies your profit and loss, staying strong at the top while the stock price remains at or above $100. But as the stock price declines, the yellow line slopes downward, illustrating how your profits may diminish while losses accumulate. No matter how challenging the journey may become, you are committed to the investment process, empowered by knowledge and strategy. Why do options exist? Contrary to popular belief, options weren't invented solely to give hedge fund managers something to do between yacht parties. They exist because investors like flexibility, traders like leverage, smart people like protection. Everyone loves income. Options are tools. Like army knives for your portfolio, they can help you. Speculate, a fancy for take a smart bet. Hedge, protect your portfolio from going splat. earn income even when your stock just sits there doing nothing. You don't need millions. You don't need a finance degree. You need to know how to use them without poking your financial eye out. Buying versus selling options. Choose your role. In the options world, you're either the person buying the contract or the one selling it. Buying options means paying a premium for potential profit. You're hoping the stock moves in your favor. Selling options means collecting that premium. You're okay if nothing happens, and sometimes even hoping for it. Let's simplify it. Buying a call means I want the stock price to increase. Selling a call means I hope the stock price remains stable or decreases. Buying a put means I believe the stock price will fall. Selling a put means I want the stock price to rise. You can play on either side of the table if you know the rules. Why options can be safer and smarter than stocks alone. Wait, did we say options, those mysterious misunderstood creatures, can be safer than stocks? Yes we did. Here's why. Minimal risk. When you buy an option, the most significant loss you can incur is the premium you paid. Much like purchasing tickets for a film. If the experience is underwhelming, there's no refund for your money, but at least you didn't jeopardize your home. Built-in insurance. Want to protect your stock from a drop? Buy a put, which is like a financial umbrella. Income strategies. You can get paid to hold your stocks. That's right, get a paycheck for owning what you already have. Lower initial expenses. Rather than investing $10,000 to acquire 100 shares of stock, you can utilize options to manage the equivalent stock for a much lower cost. The key word here is strategic. Options give you choices, and when used properly, they can reduce risk, increase returns, and provide you with control in a market that loves surprises. Common stock options mistakes. Mistake number 1. Confusing calls and puts like they're gym equipment. If you're bullish, believing a stock will rise, you buy a call. If you're bearish, anticipating a drop, you buy a put. Could you not mix them up? It's like pressing the gas when you mean to hit the brakes. If you've ever purchased a put thinking it was putting money in, or a call thinking you were calling the top, you're not alone. Let's move forward wiser and ready to thrive. Mistake number 2, not understanding why options exist. Options weren't created just for Wall Street types to show off. They serve a crucial purpose: hedging risk. Initially, farmers used options to secure prices on crops. Today, investors leverage them to protect portfolios, generate income, and control stocks without needing to buy 100 shares outright. Options aren't mere gambling chips. They are powerful tools. Use them professionally, and you can achieve remarkable results. Mistake number 3, buying versus selling confusion. Buying an option means you possess the right. Selling an option, you're granting someone else that right. Buy a call, and you'll root for the stock to rise. Sell a call, and you agree to sell the stock if it goes up. You may not even own it. The risk profile completely flips based on your position. Buying offers limited risk and unlimited reward. Selling provides limited rewards, but can expose you to significant risk. Be clear on your side. Awareness is your ally. Mistake number 4, thinking options are too risky. Options can be safer than stocks. Surprised? With options, you can manage losses, restrict costs, and even generate income while holding your equity. Have you ever heard of a protective put? A protective put provides insurance for your stock, limiting losses while keeping you invested. For example, if you own a stock worth $100 and are worried about short-term drops, you can buy a put option with a $100 strike price for a $10 premium. This gives you the right to sell your stock for $100, even if the market declines. If the stock rises to $120, you won't use the put and it will expire worthless, costing you only the $10 premium. However, if the stock falls to $80, the put allows you to sell for $100, avoiding a $20 loss. In that case, your total loss is just the $10 premium. When utilized wisely, options can reduce risk. When used carelessly, they can increase it. Mistake number 5. Ignoring time and volatility. The invisible enemies options aren't just about price, time, data, and volatility, vega. If you're holding a short-dated call on a sluggish stock, congratulations! You've just bought a melting popsicle. Options decay over time, and that's a fact. It's called time decay. It doesn't account for your bullish sentiment. And volatility, it drives up option prices. High volatility means high premiums, a greater urgency to be right quickly. Acknowledge these silent challenges, and you'll be equipped to succeed. Closing thoughts. Options may not be magical, but can dramatically transform your investing experience. They enable you to make smart bets, hedge your risks, and profit like a pro, all from the comfort of your home, possibly in your pajamas. The secret? It's not just math or timing. It's understanding the market. The market respects those who know their Greeks and have a solid exit plan. There you have it. Thank you for watching Min Chao's channel, where law, finance, and real estate come together for an enjoyable experience. Please like, comment, and subscribe for more tips and laughs. We look forward to seeing you in the following video.